Hello, fellow YouTubers, investors, teachers, and anyone watching this channel. I just wanted to go over a buy low and then sell high strategy, and I'm going to be implementing part of it in the next few days. It's more of a sell high first, and then with what I sold, buy low. And it's going to involve REITs, which are real estate investment trusts. I'm going to be selling some of my large cap REITs from VNQ, which is a REIT index fund, and purchasing a small cap REIT fund, kbwy. And I'm going to show you my thought processes of why I'm doing so. Okay, all of these videos I'll be linking are from Seeking Alpha. This is the State of REITs in September 2019 edition. The average REIT had a positive total return in 7 of the first 8 months of the year, and it was almost over 0.5% in just August. Large cap REITs had an excellent month, outperforming small cap REITs by 589 basis points. That's quite a bit. The majority of REITs had positive total returns. Data center and storage REITs led all property types. Malls and shopping centers saw the biggest share decline. And 92%, this is the key part here, 92% of large cap REITs traded a price to FFO premium to the average small cap REIT. The key part that I'm going to show here is in the last month, large cap REITs returned 4.5%. That is a huge gain for 1 month. Notice the small cap REITs declined 1.38%, and even micro cap REITs declined 1.5%. I currently have all of my investing in VNQ, which is the Vanguard Real Estate ETF, all my REIT holdings. And you can see since January, end of December, $71.74 a share. And we are currently at $93.45 a share. It went up $22 a share in the last about 8 months. That is a dramatic increase. It's higher than the S&P 500, pretty much higher than almost any type of asset class this last 8 months. Also notice the yield is 3.8%. So just by holding your money there, you're getting almost 1% every quarter of whatever number of shares that you buy. Unbelievable gains in the large cap REITs. This fund is kbwy. This is the small cap REIT fund. And you can see it's pretty steady the last 8 months. The low is 26.11, and currently we're at 30.85 or so. The yield is quite a bit higher. If you're looking for current yields to build your dividends up, they're at 6.18% per month. This is actually a monthly yielding ETF. So you're going to get 0.5% out of what your holdings are every month. So if you want to start off your dividend journey or getting some good cash flow in, this is a really good fund to start with. Now again, the large cap REITs have significantly outperformed the small cap REITs in the last 8 months. As you can see here, large cap 29.13%, small caps 20%. So small caps didn't do bad, but large cap did quite a bit better. I want to show you one of the key parts of this article that I saw. Dividend yield. Most of these companies are small cap REITs. That's why it's providing 6.5% instead of the 3.8% from the large caps. A lot of these REITs, 8, 9, 10% yields. More of the larger cap REITs, they typically have the lower yielding properties. Still pretty good dividends though, because REITs have to give out 90% of their earnings back to shareholders in dividends. One of the key things to see here is the price to FFO. Long story short, the REIT price is the share price for a particular company. Divided by FFO is the essentially earnings that they are making. The lower the number is, the more your money's actually going to, because you're paying less dollars for your price to get the earnings. Right now, micro and small cap REITs are 13.2, 13.8 times the FFO. It's very similar to price to earnings ratios. These numbers are quite a bit lower than the large cap REITs, which is 22.1 times. It is almost 9 times. Essentially, you're paying $9 more a share to get the same amount of earnings that the small and micro cap REITs are providing. Again, average small cap trades at 13.2, and 92% of large cap REITs are higher than that. Now, it says there might be certain advantages from large cap REITs. They have economies of scale, much bigger companies. They could possibly buy bigger properties at better discounts, but it's not going to necessarily be that much of a dramatical difference. Because of this, I am going to be taking my VNQ and I'm going to be selling $1,000 worth of VNQ. I actually earned about $1,000 from January till the end of September, like you see here. So that extra $1,000 is going to go into this fund. Doing a quick chart of how to essentially make your money. This was in an older clip on how I reinvest dividends to keep your money growing. So if I have a simple chart, this will be time, and this would be, let's just say share price. I'm not even going to count dividends yet. What a lot of investors do is, say a share price is doing this. What a lot of investors do is they typically will see a big gain in share price right here, and they're going to buy high, assuming that it's going to just keep going on forever. The problem with this is, many times when a share price dramatically increases, you see these decreases that happen as well. If I take this chart and let's say I bought here and then sold here, I'm going to be locking in the gains. And then let's say that there's another fund in brown that correlates like that. I might be able to buy my shares at a lower price, let's say right here, a different color. And then I'll be buying low. Okay. Rebalancing portfolios, I think, is pretty useful. That's when you're taking a certain percent of your asset allocations, so a certain percent of whatever funds you have, buying at a certain percentage. So if one of them, like let me get rid of some of these lines, like the one in green, let's say I was right here, I would have a much larger asset allocation in this particular fund compared to, say, one that does this. Okay. If I was able to buy, let's say I'm selling here, and then I see that this particular fund in yellow is decreased, you could actually buy the lower shares because the asset allocations would be incorrect. So again, VNQ, I'm going to be taking essentially pretty much all the gains that I made from here to here, and I'm going to be buying this fund that's currently right here. Okay, based on the share prices and the price of FFO, again, price per amount of earnings that the companies are making, I'm actually getting more value in my money because I'm putting in money at a lower price to essentially earnings ratio. With high price to earnings ratios, the market is assuming that it's going to continue increasing at very dramatic rates. There is a margin of safety, of a margin of value by buying lower price to earnings ratios. Okay. Also did some research on some of the small cap funds. The main fund that this has is Washington Prime Group. And I'm going to type in the nearest mall to me. This is called Rolling Oaks Mall in San Antonio. We go here all the time with our kids. Washington Prime Group is a pretty distressed company. It's one of the lowest share prices that it's been in a long time. They're paying a very high dividend because of that. And a lot of analysts are thinking that they won't be able to continue the dividend, which is about mid-20% right now. We've been to the Rolling Oaks Mall many times. They do quite a few of fun events for kids. If you look at the investor relations and company and whatnot, just this weekend we went to the mall. They had a big giant sized chess set. The kids were loving playing it. They have different events they had like a little carnival games, different prizes and whatnot. And that's all provided by the mall just to be continuing keeping companies to lease there. Essentially, this company owns the whole actual physical space of the mall, then they lease out to different companies. Sure, if the retail apocalypse continues, it's going to be a little tougher for them, but Washington Prime, as well as some other companies, are doing a lot of things to try to prevent a lot of declining leases. So they're doing mixed use malls, mixed use properties. This mall has a bookstore that children can actually write their own books and get it published. They have different arcade games and video games where they collect money directly through their space. They also have daycare centers there. There's multiple ones. So Washington Prime is trying to come up with creative ways to keep the leases coming. And I think in the next few years, it could be a bit bumpy in the terms of earnings. They probably will have to cut their dividends. And in the end, I think 2 to 3 years from now, they should be able to be recovering fine. kbwy, which I'm investing on, they own about 7% of that particular REIT. They invest in a lot of different REIT types of sectors, so hospitality, urgent care like daycares, data centers, and so on. So it's pretty well diversified. And that'll be it for now, and I'll talk to you guys next time. Feel free to like, subscribe, click the bell, all that good stuff that you hear from other YouTubers. We just hit over 1,200 subscribers, so seeing a lot of growth there. My channel is monetized, and I will be doing a video at some point showing the earnings there and how I got to get to the amount of subs that I have. I did hear from actually 2 different people asking what am I doing to increase my viewerships, and I'll probably do a video on how I'm going about that as well. All right, guys, have a great one, and I'll talk to you next time.